Thanks everybody for joining us here as we're kind of in that back to school period where everybody comes back from vacations, looking towards year end and starting to think about the coming year. This webcast is entitled Survivor, and I came up with this title for a few reasons, one of which is now that I'm so far into my career, it's just about every single person that was notable in the fixed income business when I started in the business. They're almost all gone, almost all retired or moved on to something else. I think just Dana Emery at Dodge & Cox has been around for this period of time. It'll be interesting to see which one of us is the sole survivor. I plan on being around for a while. Also, survivor is kind of a word I'm using for Jay Powell, who seems to be surviving a lot of suggestions and hostile incoming fire. And since we have the Fed next week, a week from tomorrow, we're going to start talking about the Fed here. I'm going to be, per usual, on CNBC after the Jay Powell's press conference a week from tomorrow. And we're going to be filming that live with Scott Wapner from our DoubleLine trading room, which we do usually once or twice a year. So on the screen now is one of my favorite slides. It's the Fed funds rate showing how it's led by the two-year Treasury. And this goes back 21 years. And it's quite obvious that when the gap between the two-year and the Fed funds rate, the 2 years the blue line, the Fed funds rate is the beige line, when it gets really big one way or the other, it's usually signaling that a Fed move is coming pretty quickly. We say that a year ago, back last September, we had the biggest gap on the two-year being below the Fed funds rate of any time in the past 21 years. And the Fed had to come up quickly to get in sync with the two-year, drop rates fairly quickly. And we saw that happened by basically January of 2025 this year. But now the gap is getting wide again, and we're almost 100 basis points below the upper band of the Fed funds rate. And so, not surprisingly, there's been a lot of talk about sequential Fed cuts coming up. And I think there'll be no surprise at the meeting next week, and the Fed will almost certainly cut rates probably by 25 basis points. But we'll see what the inflation data, this is inflation week here, with the CPI coming out and the PPI coming out tomorrow and the CPI coming out on Thursday. It'll be interesting to see what that brings. Certainly, the employment data that's come out has been surprisingly revised. This morning we heard that 911,000 jobs were revised out of existence for the past year. And that's on top of 1 year ago, about 818,000 jobs. So we seem to be getting weaker and weaker data reporting with much more delays in terms of when surveys would normally be filled out and when they actually are filled out. Ultimately, the response rate on many of these surveys is not that different than it was years ago. It's just that the first month, the response rates are very low, only about 40%. Once you have month 2 and month 3, where the surveys finally trickle in, we're still up to a 95% type of survey rate. A lot of people are wondering what's going on with all these large revisions. I'm not sure there's anything nefarious about it, but there is a strange pattern that the revisions seem to be on the negative side virtually all the time. There's maybe one exception in the past 15 years or so where the employment jobs data was actually adjusted higher. So Fed's going to cut rates and get more in line with the two-year Treasury. Here we see, going back 11 years, just the path of parts of the yield curve. So in the upper left, we have the two-year Treasury, and that's at a low of the past 3 years. It's very near the low point of the last 3.5 years, really. 5-year Treasury is more in the middle of the range of the past 3 years, although it's probing to the downside. The 10-year Treasury yield is actually above the average of the past 3 years in terms of its yield. And the 30-year Treasury has started to drop in recent several days, but is still quite elevated. In fact, it's near the high end of its range. So, of course, the yield curve has been steepening. So it's been a pretty good time period for fixed income. We'll see how that's been fairly consistent across sectors in a few moments. We keep hearing a lot about the Treasury Department maybe restructuring the way that they issue bonds and T-bills. This is a history going back to 2022 of what percentage of Treasury issuance was T-bills. And it's very high right now at 84%, which is the same as it was prior to the global financial crisis. And it got all the way down to 68%, but it's always been quite high, the issuance of T-bills. A lot of people, and I agree with them, think it was a big mistake to not extend out the maturity of the Treasury borrowing when we had the long bond at 1.5% interest rates, but instead we borrowed short term still to a very large extent. One thing a lot of people don't know is just how what a small percentage of bond issuance the long bond represents. When we say long bond here, it's the 20 and 30 year, so 20 years and out. And it's a tiny percentage. It's only 1.7%. Secretary Bessent has spoken openly about potentially buying back some of the long-term Treasury bonds, in essence, borrowing more on the shorter end of the yield curve and retiring some of the higher yielding longer-term Treasuries. There's not a lot of that to be done, considering that long bond issuance is less than 2% of total Treasury issuance. I think most people would have guessed that the percentage of long bonds would be quite a bit higher than 1.73%. With the changes in the shape of the yield curve, we've had a strange return experience year to date, where we see that the 30-year Treasury bond is the lowest returner. It's only up 3.24% in total return. The best returners are in the belly of the curve. The 5-year Treasury, something that we've been involved in at 6.25%, and then 7 and 10-year Treasuries up at about 7%. So the return of longer-term Treasuries is half that of the intermediate term part of the Treasury curve. This is one of the reasons that we have a nice outperformance again this year, with the positioning having been fortuitous on the yield curve. It's not just the United States that's been experiencing steeper yield curves. We see the United Kingdom, Germany, Japan are also showing a widening of the yield curve. They were all inverted except for Japan back in 2022 and 2023, and now we've seen movements of almost 200 basis points from where the maximum inversion was out to where we are now. So this has been a pretty significant change in the maturity structure of the Treasury yields. Here's 30-year Treasury bond yields in these various countries again, and we see we've had sell-offs in long-term bonds for Japan, United States, United Kingdom, and Germany. And the United States and United Kingdom are pretty similar in terms of how much the movement has been. Yields have gone way up, and that of course, has created drawdowns for long-term Treasury bonds. And the Barclays aggregate index in general is still in a drawdown for the past over 5 years, although now on total return basis, it's only about a 4% drawdown from the peak performance on the aggregate index total return wise. It was as bad as about down 20% for a brief moment. So there's been a nice clawback in the performance of investment grade bond returns. The Fed obviously is focused next week and all the time on inflation and the employment picture. And so I'm going to spend time talking about those two aspects in some detail. Here's the sort of the most commonly cited inflation series. It's the CPI. And we see the headline CPI is in the darker line. It's ticked up to 2.7. And then we see the core CPI, the ex-food and energy, is now a full percentage point above the Fed's stated goal of a 2% year-over-year inflation rate. We're now at 3%, and the most recent tick was higher. So the Fed isn't really at their inflation target. So some people are wondering why they're so keen to ease. But it's pretty clear that the 2-year Treasury is telling them to ease, and they do follow the 2-year Treasury, as we saw in the first slide. And also, these downward revisions in the employment data cannot be taken very favorably by the Fed, who wants full employment as the second part of their mandate. Now, the interesting thing is the CPI was tracking at the 2% target level from 2005 until 2020. It was right there at the 2% level on the core CPI. But then, of course, we had all of that stimulus and money printing back a few years back, and that put the CPI on a much steeper upward trajectory. So if we really have 2% as the long-term inflation goal, there's a long way to go for the blue line to converge onto the dotted beige line. I mean, we're several percentage rates. We're about 8% higher or so than that 2% trend line. So we'd actually need like 8 years of 1% inflation to get back to that dotted line. That doesn't seem to be in prospect. So the Fed instead is just really focusing on year over year, and at times even does things like annualizes shorter term periods. So 3 months annualized, 6 months annualized. Looking at that point of view, the inflation rate is pretty well behaved so far in 2025. For the first 8 months of 2025 or so, we've been running really at about that 2% level on the year-to-date CPI annualized. Here's a chart I used. This was from Apollo, I think, originally. Give credit where credit's due. It's really an amazing thing. We've got the peaks of the 70s inflation, the first peak of 70s inflation, arbitrarily lined up with the peak inflation rate under the Biden administration of 9.1% CPI year over year. That was a big number, but it's strange how the pattern of the inflation rate so far since 2014 has been remarkably similar to the 1970s inflation. I hope that we don't continue to show this pattern, because that would mean that we're about to embark on an acceleration in the inflation rate. That would not be taken well by the long-term part of the bond market, I'm sure. I certainly don't predict that we're going to follow the 1970s inflation, but it is an eerie coincidence, I must say. So the federal government is kind of running something of an inflationary policy, talking about cutting interest rates and really goading the Fed, poor survivor Jay Powell, into trying to cut 200 or 300 basis points. It will be very interesting to see what comes out of the press conference a week from tomorrow. I'll be certainly following it very closely and commenting on it, as I said, live from DoubleLine on CNBC. Here's the producer price index. It used to be called the wholesale price index, and this does typically lead the CPI. So we see the producer prices have definitely bottomed out on the final demand headline number, now at 3.3%. So it doesn't seem all that likely that we're going to be seeing a relaxation in inflation. With our double-line inflation model, which has been pretty good over the years, we think we're going to end this year with a 3 handle on the suite of inflation indices, and the PPI on this chart certainly shows that. The final demand, excluding food and energy, has been better behaved. It's still well above 2% at 2.8, but at least it hasn't started ticking up, at least not yet. The Fed likes to talk about the PCE, personal consumption expenditures, and here this index has, I think they like it because it tends to print a little bit lower than the CPI and PPI. And in fact, we see here that the headline PCE is at 2.6, so not that far above their target rate of 2%. And we did get down there on the year-over-year PCE, almost at 2% a couple of times in the past year and a half or so. But now we're kind of going sideways. Unfortunately, the core PCE is closer to its rather narrow band of results over the past 2 years, but it's kind of near the upper end of the band at 2.9%. Frequent listeners will know that I like to look at the most unadulterated price indices, and those are import and export prices, which do not have lots of adjustments to them, and they're just real prices. And so we see that the blue line, the import prices, are actually negative for the most recent reading, negative 2.2%, whereas export prices are pretty well contained at 2.2. I mean, if you average the two of these, the import and export average is only 1% year over year. So it doesn't look like there's a lot of inflationary pressure, but with the Fed easing potentially and causing a steeper yield curve potentially, then we might see some inflation start to filter in the year 2026. Home prices are one area that doesn't look like it's inflating any longer. This is year over year and month over month home prices. So you got the Case-Shiller 20-city home price index on top, and it's been moderating. I mean, look at those years back in 2021, 2022, when it was running at double digits and even close to 20% for a short while. And now it's decelerated down to about what the Fed wants, 2% on the home prices. But if you look at the bottom panel, this is the month over month. We've had a number of months where the Shiller 20-city index has negative price movement on a month over month basis. I'm sure that has something to do with affordability, which we'll take a look at in a moment. This is shelter inflation and home prices. And we have on here is the Case-Shiller home price index. And then we actually have the consumer price housing shelter owner's equivalent rent, which it lags the Case-Shiller prices by about 15 months is the closest fit. And so we've plotted that out on this exhibit. And it shows that the Case-Shiller index should lead to moderating home prices for the consumer price index shelter component in about the next 15 months or so. It's not a huge drop that's being indicated, but it doesn't suggest that we're having incremental housing inflation as a significant part of the CPI. It is about 30% of the CPI. Now, here's the affordability. This is from the Atlanta Fed, and they take the median home price, and then they calculate what the median payment would be based upon the present interest rate, and they divide it by the median household income. And so what percentage of the median household income would go to a monthly payment? This is on purchases, not on rental. And so we say for purchasing houses, we have the highest percentage going back 20 years in terms of how much of someone's median household income has to go to the mortgage payment or plus the taxes and the insurance on the property. And that's a very big percentage. It used to be a rule that it was only prudent to lend to people if they were putting about a third or maybe only 30% of their median household income into the home payment. And we're now almost, we're more than 50% higher than that at this time. It's hard to see how home prices can go up that much more unless you have significant expansion of median household income, which certainly has gone up in recent years, but it's been far outpaced by the cost of maintaining and paying a mortgage on the property. Looking at some more high-frequency inflation information, here's the Bloomberg Commodity Index, which has been very well contained over the past 2.5 years. It's really been dead sideways. We've got the beige line on here is the 200-day moving average of the Bloomberg Commodity Index, and it keeps vacillating above and below for the past year. I think it's spent most of the time slightly above its 200-day moving average, and it's crawled back above it in the last several days. But almost all of this is due to precious metals, silver and gold. Energy isn't doing anything, and most other foodstuff type of commodities have not been doing very much. It's really gold and silver. Here's gold, which I turned positive on back, I don't know now, it had to be a few years ago. It's doubled since then. Back when gold was at 1,800, it was consolidating, and consolidated for a couple of years at around that 1,800 to 2,000 level, and then broke out above 2,000, at which time I said, I think gold this year goes above 3,000, and actually updated that a few months back, saying I think gold could very well go to 4,000 this year, and it's gone straight vertical. We had a consolidation period a few weeks back, and I made the comment that something that goes up this much and doesn't drop, but just consolidates going sideways is usually a precursor for another breakout to the upside, which has just transpired. So gold now above 3,500, and there are many days where gold has movements of over $25, and I've seen quite a few days in the last few months that gold has actually gone up by even $50 in a single day. We can also compare gold to Bitcoin. Bitcoin has done well this year. It's up 19%, but gold has had double the return of Bitcoin. So it's clear to me that gold has become more of a permanent allocation for a lot of people. There's that fund that used to be called the permanent fund that had 4 categories in it that was like gold and cash and stocks and maybe commodities. I don't remember, but the that's doing quite well because gold is obviously outperforming stocks and it's outperforming Bitcoin on a year-to-date basis. So I'm still hanging in there, owning gold until such time as we get a totally different regime as regards the deficit situation and the kind of international flow situation, which is now kind of not benefiting the United States. And I think that's going to be a trend for the next few years. Here's some very, very important. These are not high frequency. These are long-term lead times for recession indicators, and one of them is the 2s10 yield spread versus its 12-month moving average. And it's interesting that when you get the crossover above the moving average, you're kind of on recession watch. But once you get the 12-month moving average, the blue darker line, once it goes above zero, having been below zero for an extended period of time, it's a pretty good coincident indicator of the leading edge of recession. In fact, it worked in the 1990 recession, it worked in the dot-com bust recession, and it worked in the global financial crisis, and it sure is above, not by a little, above the zero line. So it'll be interesting to see. Many of the indicators that had worked while interest rates were in a secular decline really stopped working as interest rates started to rise a few years back. That's has a lot to do with all of the radical changes in fiscal policy and in monetary policy over that time period. Another thing that's starting to factor in the equation, I think this has a lot to do with the jobs market, is the participation by the baby boomers is in a steep decline and will be for years to come. And now with negative immigration or zero immigration with Trump's policies, we now have a regime that I think is going to be a lower baseline jobs add on average per month. We used to be looking at maybe 150,000 or at least 120,000 jobs per month, but it's quite possible that the new baseline is going to be more like, 25,000, maybe 50,000. And what this might lead to is if the Fed uses the paradigm of secularly declining interest rates of the demographics that are no longer in place, that had been in place for decades, it's possible that the Fed is a little too easy. Maybe they ease because we're only getting 40,000 job growth, but maybe that's the baseline that the demography of the country can really sustain. We're thinking about that a lot, and we think that it could be a policy error of excessive easing. Certainly Trump wants excessive easing. So we're worried about inflationary policy. The yield curve has stopped steepening. We got from 2s to 30s, we got out to about 130 basis points or so, and now we're down at more like 117 or so. It's not a big change, but we have had a pause in the steepening of the yield curves between 2s and 30s. Another recession indicator for sure, another one with a big lead time, it's not high frequency, it's the unemployment rate versus its 36-month or 3-year moving average. And when that crosses over, as you see in the 1990 recession, again, the dot-com bust, and the global financial crisis, right when you cross over, it tends to be suggestive of the front end of a recession. This crossed over now well over a year ago, and still no recession. But it has been accelerating on the upside. This is probably the primary reason why the Fed is likely to ease. The participation rate in the economy was very low, not the most recent month, but the one before. And the unemployment rate, if participation rate had stayed the same, the 4.2 unemployment rate that was reported a month ago, not the last one, but the one before that, would have been 4.9. And just imagine it with just do a mental image of where 4.9 would look on this chart. It would look like a pretty big acceleration. So the Fed, I'm sure, is talking about all of these things and should be talking about them and taking them into consideration. Here's a strange development in the jobs economy, and that is that all of the jobs are now education and health services. It used to be the education and health services were less than half prior to the COVID situation, and then they remained relatively low versus the total jobs created. But now there are no jobs being created outside of education and health services. In fact, there's negative jobs outside of education and health services. It's unfortunate. Education and health services are driving things here because those are obviously significantly affected by government activity. The government obviously is highly involved in health services at this point. I mean, here in California, we've got something like 40% of the population is on Medi-Cal. And then you have education, which of course our costs per pupil for education are among the highest in the world, with not the best results in the world. So unfortunately, the economy, the part of the economy that's growing is the part that is being fueled by government intervention, which leads to higher prices and inflation being more systemic in the economy. So lots of things are changing, and yet the inflation rate has been going sideways really now for quite some time. But we don't think it's going to be dropping close to that 2% that the Fed wants to see anytime soon. Here's the Conference Board labor differential. So it's a U3 unemployment rate and the labor differential inverted up on the screen here, and the unemployment rate. Here's the 2s10s curve and the U3 unemployment rate. And this certainly has a look that, all things being equal, the 2s10s curve is suggesting that unemployment is going to go up. On the left-hand scale is the unemployment rate and the 2s10s curve, and it basically suggests that, I mean, it's clear that they're not always on top of each other, but this would suggest some significant increase in the U3 unemployment rate. But we do have to factor in this demographic change that we'll be talking about in more detail in future webcasts. Here's a different source than, this is the ADP. This is not the household or the establishment survey. It's the ADP data that comes out a few days before the first Friday of every month's establishment unemployment survey. And ADP is more small firms here in this exhibit, but we're losing jobs right now in small businesses. So again, the jobs are coming from education and healthcare. And when it comes to, regular old normal private businesses and small businesses, the job growth has completely disappeared over the last 3 month moving on a 3-month moving average basis. Here's the University of Michigan Consumer Confidence Surveys, which are just in horrible position. I mean, the confidence is at one of the lowest readings any time in the past 45 years, and it's been living at low readings. Yes, it had a moment of improvement. I think that was around the election, maybe a little before the election and post the election, but that's completely dissipated, and we're right back to where we were a couple of years ago. We hear the politicians always saying that everything's great. And yet, what's wrong with these consumers that they don't understand how great everything is when they're reporting a 58 reading, where if they're feeling good, it would be 100 reading. Well, here's an interesting study that somebody did. It's by Cummings and Mahoney, where they take economic data points, important economic data points, and they look at it and they do a prediction that based on the economic data points, where should consumer sentiment be? And it's amazing how bad consumer sentiment actually is than what the prediction is. Consumers are being told that the economic data should have them very happy, but they're not happy. They have very big gap between their actual sentiment and what the so-called model of Cummings and Mahoney says that maybe it should be. So consumers are not really feeling it the way that they used to. If you look at the mapping of this pre-COVID, it was very close, predicted and actual. And then I think one of the reasons people aren't feeling good is they know that this country is running an unsustainable fiscal path, which I talk about all the time. But these next few charts are really kind of stunning. And that is that here's the fiscal deficit since the start of recessions. And we've got, obviously, the most recent periods, the deficit keeps getting bigger. Now, I know the 2021 has a lot of COVID spending and stuff in there, but the global financial crisis, the 2001 recession, we just keep getting sequentially much bigger budget deficits. And of course, we have a $38 trillion national debt, and we have tremendous bond issuance that continues to weigh, I think, ultimately on long-term interest rates. Even though the economy seems to be softening, it seems that we're not being able to get the type of rally in long-term bonds that we used to get. And I think that's because people are suspicious of what the future might bring if you're talking about locking up money at yields in the 4.5 zone for 30 years. Here's the budget balance during economic expansions. And you'll notice that the present expansion from 2020 has by far the worst budget deficit of any expansion. During the old days, we used to have virtually no budget deficit during economic expansions. That's kind of the way it's supposed to work. But then again, in the most recent periods of economic expansions, we've been running incrementally higher budget deficits. And this pattern has not been broken, unfortunately. I keep using this one this year because I think it's the chart of the year. And basically, we're plotting the budget deficit versus the unemployment rate. And we looked at the period of the black dots, 1960 to 2017, and there was a very good fit using a regression. You see that, of course, when the unemployment rate is low, you should have a low deficit. And of course, when the unemployment rate is high, you necessarily have a high deficit. But starting in 2016, this all got blown up. And we're running low unemployment rate, and we're running deficits that are totally out of the context of that regression line. So this is something we're going to be following, and I think will become an ever-growing issue that makes long-term Treasury bond investing a little bit more dangerous. So if you want to be a survivor, I think you want, in these markets, I think you want to be positioned where we are benefiting from the changes in the shape of the yield curve as investors reassess the attractiveness of long-term debt versus intermediate-term debt. Let's talk about the cost of the debt. This is interesting. This is the 10-year U.S. Treasury yield. That's the red line. And the average interest rate paid on the federal debt. And one of the reasons we're having so many problems with our budget deficit here is the average Treasury yield, the average rate paid, rather, on federal debt was down below 2% in 2020. It was, my eye says, about 1.8%. And of course, with interest rates rising and the Fed hiking interest rates so dramatically in response to inflation, the average interest rate has gone up. It's really gone up double or so from where it was. So what does that mean for the future? Well, here's an interesting exhibit. This is the maturities of Treasury debt in the coming years and what the average coupon is on those paydowns, those maturities of Treasury bonds. And it's interesting that the things that are maturing in 2025 and 2026, the average rate that's rolling off is about 3%. So if rates are across the curve are higher than 3%, which is where they are now, it means the interest expense is going to be increasing, not only because we have a budget deficit, it's going to increase the volume, the quantity, the par value of bonds, but we also have older bonds rolling off that will be replaced with yields that are above 3%. Now, I'm certain that the government is aware of this, and the Fed and the Treasury Secretary, and maybe that's a good reason why they want to get interest rates down by more than 150 basis points, which should at least get the Fed funds rate down at 3% or lower. And also talking about paying down long-term bonds and using shorter-term maturities because they can control the Fed funds rate, whereas it's been proven that they can't control the long end. Since the Fed started cutting rates 1 year ago this month, the long-term Treasury rate has not declined. So they're not able to control long-term Treasury rates. This is when you hear predictions of budget deficits and so on, and funding for Social Security, Medicaid, Medicare, and the like from the CBO, you should be really very suspicious of their predictions. I think I used this once before, but back in 2001, they had a forecast of what the budget deficit would be in 2011. And they said that the budget would be in surplus by nearly 6%, 10 years forward from 2001 to the year 2011. But instead, it was negative 8%. So they missed by 14 percentage points, which I'm going to say is a lot. 14% of GDP miss is pretty remarkable. And I think the CBO's estimates are optimistic for the next 5 to 10 years because they assume, I think, growth that might on average be fairly accurate. But there'll be volatility to that will have probably a recession in the next 5 or 10 years, or a very high probability. They also use a budget deficit as their baseline that's substantially lower as a percentage of GDP than what our budget deficit actually is. So, and they also assume interest rates that are lower than where they are today. So there's a lot of ways for these estimates to go wrong. Now, in the credit markets, things are going pretty smoothly in recent years after the big shakeup in 2020. And then we had the terrible bond bear market of 2022 that also required spreads to go higher. But ever since then, we've been grinding tighter. We had some volatility this year based upon the tariffs of late March and early April. But that was just a hiccup, just like it was just a hiccup for the stock market. Similarly, it was just a hiccup for investment-grade bond spreads versus treasuries. They're now down at 77 basis points, which looks like the lowest in 20 years. And we're hanging out at that level. One of the things I think is responsible for this is I think people are increasingly skeptical about the credit quality of U.S. government bonds, particularly long-term government bonds. And the credit quality of corporate bonds is about the best it's ever been in terms of, their ratios, and that's of their financial situation on average. CFOs of these investment grade companies have done a very good job of moving out their maturities and taking advantage of low rates. A lot better job than the U.S. Treasury Department did, frankly, a few years ago. So spreads are very tight, and it's been that small increases in the yield of corporates versus treasuries has been a buying opportunity. This is a slide I really like. We take pretty much every sector and we chop them up into letter ratings, and we take a look at what's happened to spreads on a year-to-date basis. So the yellow diamonds are what the spreads were to treasuries for each sector versus treasuries. And we can see that almost all the sectors are about the same, the blue bars, about the same as they were at year end. So we had spread volatility in every sector around the tariffs, but they've all come right back down to basically where they were at year end. There's a couple of exceptions to it. We see that BAA non-agency commercial mortgage-backed securities have come in a little bit, so that means they've outperformed the blue bars below the yellow diamond. The same is true of CCC leverage loans. I think that might have something to do with the fact that some of the CCCs have defaulted. There's been rising default rates in bank loans. So the junkiest stuff that might have been responsible for some of the elevation of the yellow diamond, some of that's gone. And so it looks like they've tightened, but maybe the junkiest stuff has just defaulted. You can see a little bit of that in the single B bank loans too. The thing that has widened out is CCC high yield has widened out. The blue bar is above. But if we look at the investment grade sectors, they're all the same as year end. If you look at non-agency CMBS and the higher rated categories, that's about the same. CLOs are about the same as year end. So it's been a very kind of a calm year for spreads with a little volatility along the way. But net, we're running at bond returns the best in quite a few years. And as I said at the outset, potentially going to something around double digits, potentially, for a total return for the year. I think most people would not have forecast the prospect for a 10% investment grade bond return. But we're well on our way to doing that. Here's stocks versus the rest of the world. And I talked about this for several times now. We used to be way overvalued using that blue parallel lines. Basically, if you got to 1.25 or 1.3% standard deviation, you were way up there. But we can see that we got to this absolutely extreme valuation of U.S. equities versus global equities, excluding the U.S. And now that has reversed, as I predicted in January that it would, back when we did the Just Markets webcast. It's been particularly pronounced if we just compare the S&P 500 to the MSCI Europe. We're actually right back to 2022 valuations. So right now, U.S. S&P 500 and the MSCI Europe for the past 3 years has had the same return. At first, it outperformed, and then it went back to underperforming all the way into basically January of this year. And now Europe has been a clear outperformer. What has stopped underperforming, I wouldn't say it's outperforming exactly, is emerging markets. Emerging markets versus the MSCI. The MSCI emerging markets and S&P comparison, look down at the lower panel, that black line. When that black line is going up, the S&P is outperforming. So the S&P was outperforming basically nearly nonstop for all of these 10 years. And it even goes back further than that if we were to extend the time window on the x-axis. But we reached extreme valuation at year end. And so year to date, even emerging markets are outperforming. This, I think, has been such a long-term trend of underperformance. And now that the dollar has been systematically weakening, which I believe will continue as the Fed eases, certainly, then emerging markets will have a chance to really start outperforming, more in line with the prior slide, which was just Europe. And here is the real driver. If we look at S&P 500 versus MSCI Europe, we'll notice that it tracks, the relative performance very much tracks the Fed trade-weighted broad dollar index, trade-weighted broad dollar index. When the dollar's going up, the U.S. outperforms. When the dollar's going down, like it did from 2021 or so to 2026, then you see emerging markets outperform. I believe that we're about to enter a period that looks more like to the 2000-2004 period, certainly, than what we saw from 2020 to 2024. This, I think, is a big deal. And I know there's a lot of questions in the queue. I've really pre-screened a lot of them. I do think that non-U.S. investing makes a lot of sense. I think you should own non-U.S. equities for dollar-based investors where you're starting to get, and I think you'll continue to get, a double-barreled win. You're going to have nominal index outperformance, and you're going to have currency translation outperformance, which leads to a combination of very significant power. And now here's the U.S. investment position. It's interesting that the U.S. has started to underperform. Why is that? Because money's going out of the United States. For all these years, from 2006 until 2024, gradualistically, there were some short-term reversals, but $22 trillion came in to the United States from outside versus what U.S. Invested abroad. When you put 22 trillion incremental dollars into a market, it goes up. But if you start taking money out, which may have started to happen, the most recent tick certainly is a noticeable shrinkage in the investment position. That, of course, means selling of dollar-based assets, and that would be a driver of further non-U.S. outperformance. So finally, I'll show the long-term chart of the U.S. dollar. This will be my last slide. You'll notice that the dollar was going up from 2009 until 2023 or so, and suddenly the dollar index, the Dixie, this is highly weighted. The euro is highly weighted in here, but it has fallen. And now what you see is we've stalled out at about 97, 98 on the Dixie index, but we're not rallying. It's kind of the opposite of gold, which is not a coincidence, that it's consolidating at a lower level. If I would draw a trend line between that low in around 2011 through the low in about 2022, and we're quite close to that trend line. I think the dollar will fall in earnest, accelerate to the downside if and when, but I really think it's when, not if, that trend line is broken. So with that, we're at time here. I'm in a good mood this week with the Bills coming back by a deficit of 15 points in 4 minutes and 5 seconds. Josh Allen threw for almost 250 yards in the fourth quarter. on the Sunday night game. And so the Bills are 1-0. The rest of the AFC East is 0-1. And our top challenger for the first seed, I think, is Baltimore, and they're 0-1. And another contender for number one seed is the Chiefs, and they're 0-1. So it's kind of a dream week one for us Bills fans. So let's hope that we can keep that going. With that, thank you for your support. Thank you for listening to the webcast today. I'll be back in December. Here we are bumping up near year end again, and we're starting to get geared up for Roundtable Prime already. So once again, good luck and enjoy the back to school period into the holidays. Goodbye for now.